The retirement income death spiral. That doesn't sound very good. Is the retirement danger zone any better? Maybe a little. How about the more academically sounding sequence of returns risk? That doesn't seem so bad. All of these terms try to identify the same thing, a big risk to retirees, and it's simply this, that once we retire, financially speaking, the first 10 to 15 years of retirement are very important in terms of how the stock market performs and the inflation rate. If we happen to retire in a time that's moving into high inflation and bad market returns, it will have a significant impact, and by that I mean it won't be good, on our retirement and our money lasting. So we kind of know that. Certainly if you've watched my channel for a long time, you know that. The big question is, okay, that's great, Rob. Yeah, I get it. I don't want the death spiral. How do I avoid it? I can look back in history and see all the bad times to retire, but what about 2024? How can I know today if I'm heading towards that death spiral you just mentioned a minute ago, and how do I avoid it? Well, that's exactly what we're going to cover in today's video. So we're going to do two things. I'm going to show you just how difficult this and serious this problem is, just in case retirement income death spiral doesn't scare you enough. And then I'm going to actually walk through a paper. I'll just show it to you briefly. It's this one right here, and I'll leave a link to it below this video. By the way, I actually linked to this paper in my newsletter. It goes out every Sunday. This was last Sunday's. Very simple newsletter. 3 things here I link to every week, and you can see this was the retirement income death spiral article relating to retirement, videos or articles I've written, and then just some other interesting things here that I've found that week. So I'll leave a link below this video. You can subscribe to it. I'll also leave a link to this so you can check out the newsletter. All right. So I'll show you that article in just a minute. Let's first look at just how serious this problem is. And for that, I want to ask you a question. Imagine you retire January 1 of a given year. Of course, we don't know how that's going to work out for any of us. But if we assume a 25 or 30-year retirement, imagine that in retiring in January 1, if you had the benefit of hindsight, you would know that, say, starting with, we'll say 5%, and adjusting that for inflation, that you'd run out of money in just 18 years. Probably not ideal. Now imagine, it'd be nice to know this ahead of time, if you waited a year, your money would not only last 30 years, it would last 35 or more. Well, that would be good to know. Now, you wouldn't have a lot of money at the end of that time period, and eventually it'd run out, but you'd certainly last more than 30 years. And what if we also knew, though, if you waited even one more year, not only would your money last for 25 or 30 years, but at the end of that time, if we assumed we started with $1 million, you'd actually have $3 million in the bank. And you say, well, that doesn't seem possible. I mean, we're only talking about retiring January 1, let's say, of this year, or waiting a year, or maybe waiting 2 years. Can it really make that big of a difference? The answer is yes, and I'll show that to you right now. We're going to jump over to FI Calc. This is a great free calculator. It's not a retirement planner. You can't save your data and factor in Social Security and, IRMA and Roth conversions and all those things. But I think it's a great tool to supplement things like New Retirement, which is the financial planning tool I use, or any other financial planning tool. So what I've done, I've assumed a 30-year retirement, $1 million. I just left the stock bond allocation the way it was here, which is 80% stocks, 15% bonds, and 5% cash. And I'm assuming a 5% initial withdrawal, so $50,000, and the withdrawals adjust for inflation. And you can see, it succeeds most of the time, 79%. But of course, that means it doesn't succeed just over 20%. And if we scroll down here, we get this is a really great feature. It shows you 30-year periods. And the green check mark, right, that's good news. That means the money lasted 30 years. And I don't know how well you can see it, but it tells you the ending portfolio balance here. I'll show you one of these in more detail in a minute. And of course, if your money ran out before 30 years, you get that's the retirement income death spiral, I guess, in the form of a red X. One thing I want to note, you notice there's patterns here. This is not random. The red X's bunched together, and the green check marks bunched together. More green check marks. That doesn't mean they're not interspersed sometimes. This is during the Great Depression, but still, you've got 3 check marks here. If we actually increased our initial withdrawal rate, you'd see more during the Great Depression. And then you've got a bunch of green here, and then a bunch of red. There's a pattern to when retirement strategies fail, something that I'm going to be talking about more in upcoming videos. But what I want to focus on for this video are 3 years. 1973, we failed, got the big red X. And you can see here, our money only lasted 18 years, and we can actually look. For those stock market historians among you, 73 and 74, not very good stock market years. And then, of course, that ushered in high inflation for a decade. So 73, not a great year. If we go back down, though, and we look at 74, our money, we got the green check mark. That's good. Now, we don't have a ton of money left over, 350,000. So we only suffered through 74 stock market drop, but we still suffered through a lot of high inflation, but just that 1 year difference, avoiding the 73 bad market, and also having one less year of high inflation. Because remember, come 82, inflation comes down, interest rates start to come down, things start to look brighter. Retiring just 1 year later got us, to that period a little faster. And then go back down again, we look at 75, the next year. Where are we? Here it is. Not only do we get the green check mark, we have $3.3 million. So we avoided the bad markets of 73, 74. Though we had 2 fewer years where we had to endure high inflation. We got to that 1982 and into the 1980s where things were working out better, faster. Again, it wasn't a big difference, right? 1 year or 2 year difference, but the outcome was huge. We end up 30 years, we got more than three times the money we started with. Okay, you see the problem here. It's fine. We look back at history, we can see that. It's easy, right? What about 2024 and going forward? Well, we don't know. And that brings me to that paper that I showed you, Retirement Income Death Spiral. I'll show it to you again. Here it is. Again, links below this video. This is the paper. The author's name is James Sandage, and I actually emailed him some questions about this article, and he was kind enough to return my email, so I'm going to talk to you a bit about that. But what he's come up with is a simple ratio. It's very easy to calculate, and he says it can help us know ahead of time if we're headed towards that death spiral, and he has a suggestion as to what we can do about it. I want to share it with you, and you can assess for yourself whether it's something that you might use. So how does it work? So it's a simple ratio. What we want to do, imagine you retired, and every year you want to look at how your portfolio did. Is it up or down from the previous year? Now, of course, it's going to go down as you spend money out of the portfolio, but it's also going to go up or down based on stock and bond returns, however you have your money invested. So each year, did it go up or did it go down? And you want to just note the percentage change. And what are we going to do with that? We're going to create a simple ratio. Let's go to the whiteboard and I'll show you. So let's imagine the first year, you start with $1 million, you take some money out, you spend it, the market goes up, goes down, and when you're done, your portfolio at the end of the year is down 2%. So what you would do, you're going to have a fraction here. So in the numerator, let's say Notre Dame, yes, numerator's on top, we'll put 2. Now, let's imagine the next year, your portfolio, after you've taken money out and the market goes up or down, is actually up 5. So we're going to put any increases in the portfolio in the denominator. So there we go. And we're just going to calculate the percentage, right? So 2/5, I'm pretty sure, is 40%. So far, our ratio is 40%. I'll talk about what that means in just a second. Now, what happens if the next year we have another, we'll say 2% loss? So we would just add it here. So now it's 4/5. That's 80%, right? And we just keep doing that year after year. If we have, let's say we have a really bad loss the next year and we add 6 to it. So that's 10/5. So now, we're at 200%. That's not good. That would be bad, right? We're hoping, in this case, the lower the percentage, the better. So what do these percentages mean? And this comes right out of his article. And here's what he says. He says in the first 15 years, so that's the danger zone, the retirement danger zone, right? In the first 15 years of retirement, so we'll just say years 1 to 15, we're hoping for a ratio that's less than 100%. So in other words, we don't want our cumulative losses up here, right, to be greater than our cumulative gains. and again, we're not talking about stock market gains. We're talking about our overall portfolio, including we factor in any distributions we take. So it's pretty simple. What was our portfolio balance at the beginning of the year, and what was it at the end of the year? We want that ratio, that percentage, to be less than 100% in the first 15 years. Now, in years 16 to 20, because we're aging now and our lifespan, of course, is shorter now. He says it can go up to 125%, but we don't want it higher than 125% in those years. And then beyond that, he says, and he calls it years 21 to 25. He doesn't go beyond years 25 in his paper. I think we might be able to just use this for the remaining years, but we want it to be less than 150%. Now, I'll tell you what we do if we go over these percentages, but one thing I want to point out, notice that he goes well beyond the first 10 or 15 years of retirement, right? We think of sequence of returns risk as being something that matters in early retirement. One of the things he says in his paper, and he's got some data to back it up, is that, yeah, that is really important. But guess what? You can hit the death spiral after year 15. Like it's not as if there's some, rule that says after year 15, it's guaranteed not to be a problem. And he shows specific examples where you might spend half your portfolio in the first 15 or 18 years, but then deplete the remaining half in 6. If, again, bad markets, bad inflation. So unfortunately, yeah, those first 10 years or 15 years are really important, but the latter part of retirement matters as well. Okay, so back to his ratios. What does all this mean? He says, well, if you exceed any of these ratios, right, percentages, you skip the inflation adjustment. That's his solution, his way to address the risk of perhaps heading towards that retirement income death spiral. And it's his view. Again, I'll let you read the paper for more details. But if at any point, let's say in the first 15 years, you do this ratio and you're above 100%, you skip the inflation adjustment and you continue to skip it until the ratio, your ratio comes down below 100%. And he says, in fact, I even emailed him about this. I said to him, Mr. Sandage, let's say we're just retiring and a year later our portfolio is down. Let's do another fraction here. Let's say it's down 3%. So we put that there. Well, we don't have anything down here yet. We've only had 1 year and it's down. Can't divide by 0, I don't think, although I was an English major, so who knows. But what do we do? And he's, you don't take the inflation adjustment, right? So even in the first year, if your portfolio's down, you don't take that inflation adjustment. And he's even got data in his article that says even that 1 year at the beginning of retirement, skipping that inflation adjustment could have a huge benefit to your finances as it trickles through all of your retirement years. So that was my first question to him. What about that first year? If you're down, yeah, you skip the inflation adjustment. I also asked him, I said, is that the only approach you have to sort of addressing this issue, skipping the inflation adjustment? He said, yeah, that should do it. But he also added something else that's important. We know that if following something like the 4% rule is safe, but you're far more likely to die with a truckload of money if you follow something like the 4% rule than you are to actually run out of money. And so in his view, he said, you could have an approach that says if you've got a really low percentage, let's go back to the whiteboard. Let's imagine you've gone through 5 years of retirement. Maybe you've got some losses up here, but you've got a lot of gains or whatever, and I'm not going to do the math. But when it comes out, let's just say you're only at 30%. That's pretty low. He actually thinks you might be able to take maybe a 10% increase in your spending if you want to, if you're seeing really low percentages like this, because that could be an indication that far from heading towards a death spiral, things are looking pretty good. Of course, as you take more money out of your portfolio, it increases the chance that at the end of the next year, the number you put in is going to come up here because it's going to be a decrease in your portfolio value. So something to keep in mind. The other thing, he pointed out in his email to me, he said, look, I've set this thing at 100% for the first 15 years, but it's not written in stone. I mean, I got the sense that what he was saying was, if you come in at 98%, you still might want to skip the inflation adjustment. Of course, that's a decision each of us have to make on our own. The only other thing that I'll add here is that in a low inflation environment, say 2 or 3, I'll even say 3%, skipping the inflation adjustment for a year, maybe even two, is probably not that much of a sacrifice, at least for a lot of people. And we can sit here and, I've got my cup of coffee and it's, we're having a nice chit chat here on YouTube and, oh yeah, I'll skip the inflation adjustment. That's no big deal. Well, in practice, it could be really painful. If inflation's at 4, 5, 9% like it was not that long ago, skipping the inflation adjustment could entail some real sacrifice. And here's the other thing, and it gets back to what I showed you earlier, and I'll bring it back up. When we look at retirements that fail, I mentioned there are patterns, right? And you see them here. These are different, I'll call them economic regimes. And this was a high inflation regime, or the results of it, right? The late 60s into the 70s. And so following Mr. Sandage's approach, and it may be a very good way to think about it, but you could be foregoing inflation adjustments for a number of years in a row when inflation is really high. So keep in mind that, skipping a 2% inflation adjustment, probably not that big a deal for most people, but skipping a 5 or 6 or 7% inflation adjustment for 2 or 3 years in a row could be a real sacrifice, but I suppose it's better than the retirement income death spiral. So there you go. That's his solution, or at least one solution to this issue. And I like it because, one, it's very easy to calculate. And it can give us, however you respond to it, it can give us sort of an early warning sign that we may be headed for trouble. As I said, I will link to my newsletter from last week below the video, and from there you can check out his article. There, number one, right there, if it's of interest to you. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.